One of the most common questions that I get as a CPA is when a client will come into my office and they want to know which business entity is best for their small business. And as with most things in tax, I have to tell them it depends. It depends on your circumstances. So with that in mind today, I thought I would address the various types of business entities that are available to the early stage entrepreneur. And hopefully through that process, you'll be able to determine which business entity makes the most sense for your particular situation. Now, when you first start out in business, you are what's known as a sole proprietor. And that essentially means that there's no difference between you and the business. If you did not exist, the business would not exist. And as a result, it's very commonplace for sole proprietors to use their personal checking account to pay business expenses, which is largely frowned upon by the IRS in other instances. Rather than filing a separate tax return for the business as a sole proprietor, you just fill out what's called a Schedule C and staple that to your annual 1040. And that will fulfill your tax reporting requirements for that year as a sole proprietor. So let's assume that there is an ambitious young lady in your neighborhood who wants to be a landscaper. So she goes out and she buys a lawnmower and she's cutting lawns. By the end of the summer, she's got 25 lawns on account. At that point, the young lady is a sole proprietor. Again, there's no difference between her and the business. She's just going to fill out a Schedule C listing her income and expenses for the year and her resulting profit, which will then be subject to taxation. Let's call our young entrepreneur Sally, and let's further assume that one of the lawns that Sally cuts belongs to a well-established entrepreneur who starts chatting with Sally and indicates to her that it might be a good idea for her to form a LLC or limited liability corporation to sort of manage her business and operate the business under the LLC designation. So after work that day, Sally goes home, gets online with the Secretary of State in her home state, fills out a form, pays roughly $100, and now she is a corporation in the eyes of her home state. Now, so long as Sally is the only member in the LLC, it will be considered a sole member LLC and therefore, as they say, disregarded for tax purposes, meaning that Sally's essentially back to square one. She's still, from a tax perspective, she is still going to fill out a Schedule C, attach that to her annual 1040, and that will meet her filing requirement with regard to the IRS for the year. Now, if when she was forming the LLC or at any point subsequent to that, she indicated that there was more than one owner of the LLC, the default entity type would no longer be a disregarded entity where she would file a Schedule C, but would then be a partnership where she would have to file a separate tax form called a 1065 partnership return. Now, a partnership can be a good tax return for a taxpayer because it offers a lot of flexibility. You can have one partner receiving 10% of the profit and 14% of the loss, or whatever percentages you want to include in that partnership. However, the partnership return form 1065 is a much more complicated tax form to fill out than the Schedule C. So at that juncture, I would encourage anybody who is a partnership to seek the help of a professional tax person. Now, if Sally decides that the partnership return is maybe a little more complicated than she would like to get into at this juncture, there is an alternative. And that alternative is the SCorporation. The process of becoming an S-Corp begins with the business owner filling out a Form 2553. Election by a small business corporation. It needs to be signed by all the owners. You submit it to the IRS. They will eventually write you a letter back saying your S corporation begins as of this date, or it was denied for whatever reason. Now, S corporations are corporations that elect to pass corporate income, losses, deductions, credits, basically anything to their shareholders for federal tax purposes. Shareholders of S corporations report flow-through income and losses on their personal tax returns and are taxed at individual tax rates. There are certain requirements to be an S corporation. They include, but are not limited to, being a domestic corporation, having only allowable shareholders, so you can be an individual. Certain trusts can be part of an S corporation, estates, But you can't have any partnerships in your S corporation. You can't have any non-resident alien shareholders. You can't have more than 100 shareholders, and you can only have one class of stock. But for most business owners, this is not a hurdle, and they get their approval letters back. And at that juncture, they will go ahead and file a separate return called a 1120S. It's separate from the individual return, so it's a little bit more in terms of tax fees, but there are strategies you can use for an S corporation to substantially reduce your tax liability, which I'll get into in other videos. So in the end, what we have is a natural evolution where somebody typically starts out as a sole proprietor, then sort of goes to the LLC level at the state, forms a corporation, and then either elects to disregard that entity and just maintain one shareholder, or add shareholders, and at that juncture determine whether they want to become a partnership or an S corporation. This is not financial advice for your particular situation. Disclaimer. As always, if you would like to chat about your particular situation, please visit my website where you'll find information on how to reach me, and I'll certainly be glad to schedule a consultation with you. Thanks so much, and we'll see you in the next video. Have a great day.